Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and watching the Market Chameleon daily webinar series. Before we get started, let's take a look at the shared disclaimer. Be aware that Market Chameleon, Dimitri, and myself are not registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show and webinar, like all our shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonik to the stage. How you doing, Dima?
Good morning, Will. How are you?
Good. So to start the week, we're going to look at implied volatility benchmarks.
Yeah, let me share my screen here. And good morning, everyone. What we'll do is take a look at implied volatility benchmarks and indexes and see how traders use those to help get market insights, look for potential opportunities, or manage their risks. So let's go to we'll take a stock symbol. Let's say, let's do Google, for example. We'll type in Google, and we're going to go to an implied volatility chart, but the thing we want to discuss is what this means. How do we get the implied volatility and how do we use it? So let me just go on this left-hand side. There's a menu. Let's click on volatility. We're going to bring up an implied volatility chart. And then we get this line that shows us a historical implied volatility. So let me click on this menu to minimize it, expand our screen. And when we look at the implied volatility, what does this mean? Like, what is a stock's implied volatility? Because last week we talked about implied volatility of an option. Implied volatility, it's a derived value from an option pricing model and requires you to look at, have an option. You take that option and you could calculate that implied volatility. But for a stock, let's say like Google, it has many different options available to trade. We have different expirations, we have different strikes. Some strikes are far away, like you have tails, you have strikes that could be 10%, 20%, 30% away. And that option could produce a different implied volatility. You could have an option that's a leap. You could have an option that expires tomorrow. You could have one a week from now, 3 weeks from now. So when you have all these different options to look at and you could calculate implied volatility, you're going to get a lot of different implied volatilities that could vary by a lot. Here, let's just take a look at an option chain first, just to give you an idea of what I mean. If we go to Google's option chain, you can see there's all these different expirations available for trading. And if you click on one, let's say August 22nd, well, here's the option chain for August 22nd. You can see we have calls on this side, puts, different strikes. And these are the implied volatilities next to the bids, implied volatilities next to the asks. So they're different, right? You could see that depending on which option you pick, you're going to get a different implied vol. So having said that, as a trader, we try to first look at some type of index or benchmark to give us an indication, well, in general, is implied volatility high or low? Because looking at all these different available options, it's a difficult endeavor. So you need something to kind of get a sense, are we on the high end or low end of the implied volatility range? And to do that, you'd have to have some kind of like standardized or normalized option to track, right? So let's say I'm looking at here an option, 34 trading days, 49 calendar days, and here's, let's say, an at the money option. So this one is a 28 implied volatility, like 28.3, 28.7, somewhere in between there. That's the implied vol. And now to compare that, we would have to look at the next day and the day after a similar option. That means it still has to have 34 days trading days with the distance of the stock same distance, because if you're looking at an option with less days or more days, you're not comparing the same thing. It's kind of like, think of when you're looking at interest rates, a benchmark at interest rates, right? Well, interest rates with 1 month, 1 month interest rate is different than a 30-year, right? Like if you're going to go look at the interest rate term structure, it's going to be different as you go out further in time. You have a 10-year, you have a 5-year, you have a 1 month treasury, you have a 30-year. Think of mortgages. You have 15-year mortgages, you have 30-year mortgages, you have like 5-year arms. All these have different interest rates. So you'd have to benchmark something similar. So if you're looking at 30-year mortgage, you kind of need, a benchmark 30-year mortgage, right? You're not going to compare it to something different. And that's where the benchmarking comes in for the implied volatility. We need some kind of constant maturity option. In other words, if we're looking at 30 days, we need an option that's 30 days to expiration. And if we're looking at the money, we're always looking at an at the money option. But the stock moves around. So an at the money option right now, which could be like, let's say the 190 strike. Well, if the stock moves, to 191 or 195, well, now you have a 195 strike that's at the money, right? So the stocks moving around at the monies are going to change too. So having said all this, we have to create a benchmark and to see how that benchmark is changing. Okay, so this is a derived value. It's not something that, like a Google stock price where that's a traded value where, a transaction happened, there's a buy and a sell of a stock, and there's a reported price. Well, then we could say this is the price of Google. But option prices are just they're moving around with the stock because it's a derivative, right? So option values are derived from the stock, stock price. That's an input into the option prices. So it's a derivative. So we need to kind of track that value. Okay, that's what we're doing, tracking this value. And a standard, like let's say an industry standard reference, right? An industry for the implied volatility, similar to the VIX, is a 30-day constant maturity, right? So when we think of mortgages, there are different types of mortgages, but the standard is a 30-year mortgage, right? 30-year fixed. That's when people ask, where's the mortgage? What are the interest rates on mortgages? Well, the standard kind of is, well, what's the 30-year fixed, right? But obviously that's not the only one. You could have a 15-year, you could have a variable rate, you could have all these different types of structures. So in the industry, the kind of the standard reference is the 30-day constant maturity. And the 30-day constant maturity at the monies, right? So we were looking at the at the money implied volatilities. So the strikes that are, around where the stock price is. Okay. The VIX calculates it a little bit differently. They try to do a weighted average between, all the strikes. So their calculation, you could look it up, but it's a methodology, right? It's like if this option is this wide or this option is zero bid, and it's a methodology for calculation. But for our purposes, we're going to look at a 30-day constant maturity at the monies, and that's what this is over here. If we go to the volatility, implied vol, right here, we're tracking a 30-day constant maturity IV, implied volatility. That's what this line is. And by doing that, now we could visualize and assess where it was historically. Are we on the high end or low end? Just like 30-year mortgage, right? You could plot a 30-year mortgage. Where are we on the low end or high end of the historical range? Okay. So, and even a 30-year mortgage, there is a benchmark actually, because a 30-year mortgage, when you guys think about it, there's no one right 30-year mortgage, because you could go to different banks, right? You could go to 5 different banks. You might get 5 different rates, and you might get different rates in California and different rates in Pennsylvania. So there's no even like right 30-year mortgage, right? You could really, because sometimes people say, well, your implied volatility is different than the other, but it's a derived value. In other words, you could look up a 30-year mortgage and go to the bank, and they might give you something different. It could be lower, could be a little bit higher, but there's a benchmark that we look at, calculate, right? The 30-year mortgage might be whatever it is, the average of, the top, whatever, 50 banks. And that's what we're tracking here. Okay. That's what we're trying to track here, is a methodology, so we could see if it's going up or down. So this is the implied volatility for the 30-day constant maturity at the money. And this allows us now to plot it and see historically, well, where was it? Where was the high? Where was the low? Where are we now? Where does it look like? How does it fluctuate? Right. So I could actually put in, let's say I wanted to see where are we relative to the 20-day moving average, right? So there's a 20-day moving average versus where we are, and we could see how, because a 20-day moving average is a little bit more smooth out, right? You're averaging out 20 days and it's a moving average. So then this allows us to see how it fluctuates around the 20-day moving average and how far we are away currently from that average. And historically, how much does it deviate from it? We could also plot it then against the historical stock. So this allows us, here I'm going to remove the volume, but this allows us to compare the implied volatility versus the 20-day historical volatility, right? So how far away does it project forward volatility relative to the last 20 days? And how far apart do they get? We could also look at just a much more smoothed out 252-day. So this is a 252-day, which it won't fluctuate as much because now you're averaging out 252 days. So every new day, you get a new volatility and take out the old, right? Moving average. So this allows us to compare the chart on a relative basis to see how far away are we from that 252-day moving average realized volatility, right? So we could compare the stock volatility versus the options implied. Since we're creating a benchmark, we could create other benchmarks. And one way is by term structure. We don't have to stick with 30 days. We could go out further. We could go out shorter. So here's an example of a term structure where if we click on this tab, this shows us a 30-day implied volatility, a 60-day, 90-day, and 120-day. So you see we're changing the constant maturities. And by doing that, we could plot them versus each other or the differences. Let's say we wanted to see difference. So the difference is 60 minus 30 with the ones we have, 90 days versus 130, 100 days. So I'm going to uncheck these to show you. So this is the 60-day implied volatility minus the 30-day. So if they were always exactly the same, let's say the implied volatility of 60 days out versus the implied volatility of 30 days if they're exactly the same, move the same. If they were both 20, or if they were both 30, if they were both, so the difference would be zero, right? The difference would always be on this zero line. But what we're seeing, it fluctuates around. So if the 60-day is higher than the 30-day, we're going to be above zero. If the 60-day is lower than the 30-day, we're going to be below zero, right? So if you have let's say the 60-day, the longer term is 20, and the 30-day is 15, then it's above, right? Then the 60-day is above. You'll have a positive. What if the 60-day is 20, but the 30-day is 25? Well, 20 minus 25, you'll get a negative, so it'll be below. So you could see that it fluctuates around 0 too. That means the term structure is moving around. Sometimes the shorter dated options are lower than the longer term. Sometimes they're higher. So this shows us where we are now and where we were historically and how far apart they got, right? How far the distances got. We could also go down here and compare the term structure relative to a historical. So this green line here is showing us here the 30-day constant maturity, the current one, 60-day. So you could see that the 30-day is currently higher than the 60-day, and then the 90-day starts moving back up, and then the 120-day is even higher. Okay, so that's what the term structure looks like. And this red line shows us the previous day. So we could see the whole line shifted, the term structure. It shifted higher. It looks similar, right? The shape of it looks similar, but it just shifted higher. The green line went up across everything, kind of proportionally. What if we wanted to see a month ago? So click on this. Let's take off the previous. So a month ago, this is that yellow line. This is what it looked like. The 30-day was up here, then it sloped lower. On the 60-day, it sloped even lower. On the 90-day, and sloped even lower, but not as fast-paced on the 120. And it looks higher 1 month ago than we are today. So you can see here today, we're down here. There's a green line. And we could do that for strikes as well. So the idea here is that we're creating these benchmarks to quickly assess for different securities, right? So we have all these different securities, where we are, or where the implied volatility benchmark is, or index, let's call it an index, versus historical data. Are we on the higher end, on the lower end, and what could that market be signaling, right? So on the lower end, the market's signaling that they're forecasting lower volatility than usual. On the higher end, signaling that, oh, well, forward volatility looks like it's going to be higher than usual. Term structure, same thing. We're looking at what is the shorter term versus the longer term indicate. So, Will, I'm going to throw it back to you. I covered that implied volatility page at this point.
Yeah, that was a great start to the week, D. Thanks for these webinar series as always. You have a great day, and we'll see you tomorrow, my friend.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
All right, we'll see you tomorrow, D. Bye. Hey, everyone. Thanks for joining the Market Chameleon daily webinar series. If you're following us on the social platforms, please like, share, comment. If you're on YouTube, thumbs up, always helpful. Everyone have a safe trading day out there, and we'll see you tomorrow. Have a great day, everyone. Bye-bye.